While the financial media obsesses over every twitch of the stock market and the S&P 500 like it's a toddler's heartbeat monitor, there has been something else much more worrisome going on in the financial world. You see, there's a market that is arguably more important than the stock market that is actually signaling a potentially devastating blow to the economy, and that is coming very soon. Or it might already be here, depending on who you ask. And well, all of this is because in this last week, treasuries and bonds might actually be showing a full-on financial crisis is imminent, or that a quiet to long collapse of the economy is underway. You see, the treasury bond market is a reflection of how confident investors are in government solvency, inflation, stability, and economic growth, and when things go well, bond yields stay predictable. When things go sideways, yields spike like a 13-year-old watching the Dawn of the Dead for the first time. And guess which one we're seeing now? Well, let's just say the dead are rising. So what has happened in the bond market? Well, let's start off with something obvious. The US bond market has had a historic spike over the last week. So in just 1 week, the 10-year treasury yield jumped from 3.99% to 4.52%, a 53 basis point leap. That marks its sharpest rise since the George W. Bush administration, shortly after they announced their war on terror in 2001. Meanwhile, the 30-year treasury yield hit 4.92%, its largest 3-day increase since 1982. Yes, 1982 is the last time we've seen something like this, back when mullets were in and inflation was a national hobby. So why does any of this matter? Well, it's because treasury yields aren't just boring government debt, they're the foundation of global finance. Everything from mortgage rates to corporate lending to how much the US government pays to service its own debt is tied to these yields. A sharp rise like this means bond prices are crashing and fast. You know, I've seen a lot of traders describing this as a full-blown liquidation and fire sale of US treasuries. The kind of desperate selling you only see when rich people are nervous that they are about to lose a lot of money. Even the most conservative investors like pension funds and insurers, they're getting killed here too. And simultaneously, smart money is quietly packing its bags and heading for the exits in the bond market. This week, global bond funds saw $25.7 billion in outflows, the biggest exodus since April 1st of 2020. And it wasn't like, there was some global pandemic that we knew nothing about at the time that was ready to crash the world economy. Nah, that didn't happen at all. But regardless, that's the perspective of what's happening for bonds at the moment. We are talking pandemic levels of panic. And to put in perspective, the $25.7 billion of outflows, that's more than the GDP of Iceland, that flushed out of the market in just a few days. US bonds lost almost $15.6 billion, European bond funds bled $12.7 billion, high-yield junk bonds and leveraged loan funds combined $22.6 billion walked out of the door as well. And well, the translation for all of this is that everyone is ditching long-term investments and running to the digital equivalent of a bunker lined with dollar bills. But there's another factor throwing gasoline on the fire, and that is the rapid unwinding of leveraged basis trades. So these things are Wall Street's favorite party trick. They're buying treasury bonds and shorting treasury futures to pocket the difference. It's boring, it's low risk, and makes billions when everything is, calm and steady in the market. But here's the thing, these trades are built on debt. Lots and lots and lots of debt. And when prices start to drop, that debt starts demanding its money back. You can think of this as the bond equivalent of a margin call. And in April, roughly $800 billion worth of these trades began to unwind. Margin calls went out, funds started dumping treasuries to stay afloat, the dominoes fell, and suddenly the world's safest asset was in full-blown crisis mode. Now, while the US bond market was having a meltdown, Europe wasn't exactly enjoying a stroll through the vineyards with their bonds either. The UK had to cancel a £600 million bond auction because the market was just too chaotic. German bond yields jumped, Italian spreads widened, and emerging markets, well, let's just forget about them. Developing nations that were hoping to borrow on the international market in April, well, that's not happening. Not one emerging sovereign market successfully issued new bonds this month, and with US yields surging, borrowing costs abroad are rising too. It's kind of like a virus. This is like a contagion of bonds spreading throughout the world in real time right now. But don't worry, I'm sure this will all turn out fine. So now let's address the real elephant in the room here, and that is US treasuries. They've always been the safe haven of the global financial system. They're kind of like the Motel 6 of investing. They're boring, predictable, they're always open. Yeah, sure, they get a few rats every now and then, but everyone's willing to tolerate that. However, now people are starting to second guess even that. Normally, when the world gets risky, everyone flocks to treasuries, but in April of 2025, we have seen a shocking reversal. The dollar dropped, bond yields spiked, and gold has been soaring. Investors are saying, hey, maybe we shouldn't stay at that rat-infested motel anymore. There's a Hilton down the road, maybe we should try them. Now, the final insult came when the US held a 3-year treasury auction and saw the worst demand it has had in years. Foreign buyers who usually scoop up US debt like it's on clearance didn't show up. And if this keeps happening, the US will have to raise rates just to attract interest, and that's a debt crisis waiting to happen. Essentially, US treasuries are no longer a risk-free asset as of the last week or two. However, this is only half the story. You see, the bond market is throwing a tantrum right now. They're pulling fire alarms and lighting flares. Essentially, there's a giant billboard flashing, "There is danger ahead for the entire world economy." Treasury yields have soared, the yield curve doesn't make sense anymore. Essentially, one of the most reliable predictors of a recession just isn't working or hasn't been working for the last few years. And investor confidence is dropping faster than Netflix subscribers after seeing the Cleopatra documentary. But this is where it gets worse. This isn't just a market story anymore. This is a government, economy, and everyday person story. Because when the bond market starts to go haywire, the United States itself starts to panic. And that's because when the bond market goes haywire, especially in the United States, the global economy becomes under threat. So why is this? It's because the US government is the biggest bond issuer on planet Earth. It is the bond market. And if the market turns against the US, if it loses the confidence of the people who buy its debt, it's like watching someone try to refinance a mortgage in the middle of their house burning down. So let's get to the real horror story for what this actually means. The United States owes over $36 trillion in debt as of right now. It's not monopoly money, that is a real debt, 36 trillion. And here's the thing. Interest rates and yields are going up fast. The United States Treasury paid $396 billion in just the first few months of 2025. That's 13% more than this period last year. Interest payments are now the fastest growing expense for the federal government, surpassing defense, Medicare, and money for literally anything that helps people. If bond yields stay elevated or worse, rise, interest on the national debt will top over $1 trillion potentially this year. Potentially by the end of this year, interest on the national debt will surpass the United States military budget. And here's the math. For every 1% rise in average interest costs, at this current second, that equates to about $360 billion more per year in interest payments from the federal government. That's 3 times the Department of Education's normal budget just gone. Just to cover interest on the US debt, not principal, not services, just interest. In essence, America is becoming a giant credit card bill that pays for its own minimum payment using another credit card. And this is something that I've been talking about for many, many years on this channel. How the US government needs to cut spending and has needed to do it for at least the last 10 years or more. And I don't think that a lot of people understand that budget cuts are a necessity. You cannot spend like this forever. This is how nations fail. But more on that in a second. So back in 2023, Fitch Ratings did something the US didn't think was possible. It downgraded America's credit rating from AAA to AA+. That's like the financial world saying, look, we still trust you, we just don't trust you like we used to. And now Moody's, the last one of the big 3 credit agencies still clinging to AAA, is circling the downgrade drain. And this is because even they can't spin a positive story on the United States debt metrics. The US now spends a higher percentage of its revenue on interest than any other AAA-rated country. There is no long-term fiscal plan to reduce the debt if Doge doesn't work out. And right now, the trade policy of the United States seems to be coming from the brain of a Florida man. And so keep in mind, a Moody's downgrade would be pretty monumental. It's not just a slap on the wrist. It can lead to higher borrowing costs across the board. Many pension funds, sovereign wealth funds, and insurance companies are legally restricted from holding non-AAA debt. If they're forced to sell, that floods the market with treasuries and raises yields even further. It's like a feedback loop from hell that keeps on going and going and going until the United States cannot physically sell its debt to anyone. So remember that treasury auction that I mentioned earlier from this month? The one where the US tried to sell 3-year notes and basically got ghosted? So that's a symptom of something much deeper, a growing reluctance by the world to fund American debt. Right now, the US depends on people, mostly foreign central banks, funds, and institutions to buy trillions of dollars in debt every single year, just to keep the lights on. And lately, those buyers are getting a little bit of cold feet, one might say. Foreign holdings of US debt have been declining over the past year. China and Japan, the two biggest holders, have both reduced exposure to US treasuries. You could say it's for economic reasons or because they'd rather not help finance America's trade wars against, well, themselves. And global investors, especially after this tariff fiasco, are asking themselves, what are we doing here? Why are we financing the United States when they are treating us poorly? So if the buyer pool dries up, the Treasury has to offer higher yields to entice interest back in the United States. This will raise debt costs, scare off more buyers, which raises yields again. See the problem? This is what someone calls a debt crisis. Now we get to another issue. If, or more likely when, a recession hits, governments respond with what economists call stimulus, and what the rest of us call checks in the mail. They also lower taxes, they increase spending, support households, and throw cash at the problem until it either works or inflation says enough. However, that strategy only works when borrowing is cheap. If the bond market's selling off and yields are rising, suddenly the government can't just borrow its way out of trouble. If a recession were to hit now, and let's be real, all signs say that it's coming, the US might find itself fiscally handcuffed. The interest burden is already crowding out other spending. There's no appetite for more deficits, and politically, we'd get lucky to get Congress to agree on the color of money, let alone how to spend it. Now sure, the Federal Reserve will probably step in, they'll probably start printing money and buying treasuries all over again. But as we've seen, all that does is make asset prices go up and doesn't help the average person. It definitely hurts the average person, at least in the long run. So imagine a recession where the government can't step in, can't intervene, and the central bank is out of ammo. That's the kind of stuff economic historians write books about. Grim, dusty books that we might see have a new chapter added quite soon. So there are a few countries where something like this has happened before. Greece, for example, from 2009 to 2015, they spent beyond their means before that. They hid their real numbers and depended on bond markets to roll their debt. Then, one day, yields spiked, confidence vanished, and boom, sovereign debt crisis was abound. The International Monetary Fund moved in, austerity rained from the sky, and youth unemployment hit, get this, 60% in Greece. It was horrible, although now Greece is one of the few countries that seems to be relatively unaffected on a macro scale in their financial world, but that's a story for another video. There's also Argentina that has happened to it multiple times. They borrowed like no tomorrow, and then tomorrow came. Bond yields hit 50%, inflation soared, the currency collapsed, investors fled, and in 2018, they got the biggest International Monetary Fund bailout in history, and yet still defaulted. And now, Milei in Argentina, under his chainsaw plan, has put Argentina into an economic paradox where the economy has been growing very well for 2 consecutive quarters, while simultaneously increasing poverty. He seemed to have borrowed Canada's economic plan of the last few years. The UK in 2022 had an issue as well. Remember Liz Truss's infamous mini-budget? Markets freaked out, bond yields spiked, the pound plummeted, and the Bank of England had to intervene to prevent pension funds from collapsing. She resigned in 44 days, essentially meaning the UK cancelled their free trial to the Liz Truss subscription. Now, I'm not saying that America is going to turn into Greece, the UK, or Argentina, but the warning signs are familiar. High debt, rising yields, fiscal dysfunction, and growing thoughts of, wait, is this sustainable? So here's the bottom line. The bond market is throwing a tantrum, and this is usually grounds for a red alert in the financial world. And if nothing changes, if the government doesn't take its fiscal health seriously, if politics continues to paralyze policymaking, and if investors keep bailing, this will be beyond a market correction. This will be a reckoning of the US economy and potentially the world economy. And just remember, if there is a problem in the US bond market, this isn't just a problem for, the US bond market. This is a problem for everyone. And if you liked this video, make sure to check out my YouTube Creator Academy in the link down below, and click on my documentaries playlist to see more videos just like this on there. Anyways, I'll see ya.